Okay, this is a review for test 3 in business finance. So I'll have this Excel document saved out in Blackboard as well. But then this, I just want to walk through what I'm doing. So for chapter 14, you're going to have various problems. Some of them will be multiple choice, and they'll be worth more points. So check your review sheet for the amount of points that they're worth. But you'll have one problem here in A where you're just going to be computing what is your break-even point. So they'll give you the selling price. In this case, it says Tony's Beach T-shirts sells the T-shirts for $29.99 and then has a variable cost of $11.49 per shirt. So that would give them a unit contribution margin of $18.50. The company incurs $120,000 of fixed operating costs. So to figure out what our break-even point is in units, we take the fixed costs divided by that unit contribution margin and then round up to the next unit. So this really gives you like 6,486 point something. So round it up to they'd have to sell 6,487 shirts. Then B says, okay, now what happens if they increase their selling price? Well, if they increase their selling price to $32.99 and their variable costs stay the same, obviously their contribution margin goes up. They make more money per unit. So then now you take their fixed cost of $120,000, divide it by the higher $21.50, means they can sell less shirts and still cover all their costs. And again, I rounded up, so 5,582 shirts. Then the third scenario says, okay, well now what happens if the selling price goes up to $32.99, but their variable costs also jump up. So if their variable costs would go up to $19.99, then they're only making $13 per shirt. So their fixed costs are again staying the same at $120,000, but they're only making $13 per shirt that they sell. So then they'd have to sell 9,231 shirts. So then you can kind of see what happens to that break-even point as they make more or less money per shirt. Then D, we have calculate our operating loss if they sell 5,000 shirts. So you have the selling price of the $29.99 at 5,000 shirts gives us total sales. The variable cost of $11.49 times 5,000 shirts gives us variable costs total. Again, we're just multiplying those together. Subtract them to get to the contribution margin, and then subtract out your fixed costs. So you can see if they only sell 5,000 shirts, they're going to be losing money. And we knew that too because our break-even point was 6,487. So if we sell less than that, we're obviously going to be losing money. Okay, then they have us do the same thing. Now, what if we sold 14,000 shirts? So again, you've got the selling price of the $29.99 times the 14,000 shirts. We have sales of $419,860. Variable costs are $11.49. Again, 14,000 is what we're selling. So that's our, multiply those to get to the variable costs. Then we subtract out our fixed costs. Now we can see we're making money. We'll have operating income of $139,000. Again, we're over that break-even point. Okay, then the last scenario is a little bit different. So the last scenario, instead of giving us dollar amounts of the variable costs and dollar amounts for the fixed costs, they give us a percentage. So they say compute the degree of operating leverage if 15,000 shirts are sold and the variable costs average 30% of sales and the fixed costs average 50% of sales. So my selling price is still the same, the $29.99 times the 15,000 units that they're telling me I'm selling. So then my sales comes up to $449,850. Then I take that and I multiply it by 30% or 0.3, and that gives me my variable costs. Subtract that out to come down to my contribution margin. Take the sales again, the $449,850 times 50% or 0.5. That gives me my fixed costs. Subtract that out to get my operating income. And then your degree of operating leverage is your contribution margin divided by your operating income. So then in this case, that's 3.5. Okay, so that is the problems on chapter 15. Again, there'll be multiple of them, and they're going to be multiple choice, but they'll be worth higher points. The conceptual multiple choice will be worth 2.5. These computational ones will either be 5 or 10, depending on how much work you have to do to get to your answer. Okay, then chapter 15, you'll have a problem on the residual dividends, where you've got to know kind of how that works. So this problem, it tells us, up there, it says the firm has a approved capital expense budget of $2 million. So that's that number. The firm maintains a target capital structure of 50% debt, 50% equity. So when we're dealing with these residual dividends, all we care about is the equity piece of it. We don't care about debt. They can go ahead and get all the debt they want. The equity is what we care about. So we got 50% equity times our capital budget of $2 million. We have $1 million of equity needs. So when we follow the residual theory of dividends, we have to first pay those equity needs out of our net income, and then what's left can go to dividends. So then the $1,600,000 is the net income. So we subtract out their $1 million of equity needs for that capital budget. That leaves $600,000 that they can pay in dividends. Then it says, well, what is that payout ratio? So if we take the $600,000 they can pay out, and we divide it by their net income, it tells us that they're paying out 37.5%. Okay, then you'll have a problem on the stock split. So it says ER stocks trades at $325 per share, and the company does a 3-for-1 stock split. So assuming it has no effect on the value of the equity, what is going to be the company's price? So basically what happens is we just divide it by 3, because when you had 1 share, now you'll have 3. So if you take the $325, divide it by 3, the new price should be $108.33. And again, that's the reason that companies do stock splits, is to bring that price down. Okay, then chapter 16, we have a few different problems. We have the cash budget problem. So we've got, they're preparing a cash budget for March. Their first quarter, they forecast their first quarter sales to be $275,000 for January, $250,000 for February, $280,000 for March. And then they give us the collection. So they are collecting 10% in the month of the sale. So that would be March. 75% the month following the sale. So again, we're focused on March. So March follows February. So 75% of February sales will come in March. And then 15% the second month following the sale. So again, we're focused on March. So 15% of January's sales will come in. So then I've just taken each month's sales times their applicable percentage to come up with how much cash will come in March. Okay, then you'll have a separate problem that has you do the whole cash budget. So it says the budgeted sales are $15,000 and are constant each month. 50% of the customers in the current month will get a 2% discount. The remaining 50% will be paid the month following the sale and obviously will not get the 2% discount. Purchases for the next month's sales are a constant 40% of the projected sales. General and administrative costs average 20% of the sales. And then they'd like us to construct the cash budget. So $15,000 at 50% will get their 2% cash discount. So again, I'm going to multiply it by 90%. You could multiply by 2% and subtract it, but then you'll get to that same answer. So then they'll receive $7,350 on those discounted sales. 50% will not take the cash discount, so that's $7,500. So our total cash receipts are $14,850. The cost of goods sold, or the purchases, are average 40% of the sales. So 40% times the 15,000 gives us 6,000. General administrative expenses average 20% of those sales, so that's 3,000. So subtract those out, and we would have a positive cash flow or a cash gain of $5,850. Okay, then the purchase discount, and there's a little slight issue with Cengage that it has the wrong answer scored as correct. So I'll adjust that, but so you might miss it when you first take the test, but I'll go in and correct it. I can't figure out how to change it myself, so I'll just change it after the fact. But this is taking the purchase discount. So we have Jackson Products has maximum trade credit by not taking their cash discounts, and they pay in their net due days. Their average terms are 2% if they pay in 10 days, net due in 40. So right now they've been paying on day 40 instead of day 10. The company is considering borrowing from their line of credit to take the discounts. If the firm purchases $16,200 per day for 365 days per year, and the interest rate on their line of credit is 8%, and they are in the current tax bracket of 40%, what would be their change to net income? So we take their daily purchases of $16,200, multiply it by 365 days to get their annual purchases. So the $5,913,000 would be their annual number. Now they're contemplating taking this 2% cash discount, so then they would have an annual savings of $118,260. So the total purchases times that 2%. But in order to take it, they would have to borrow. So then what I have here, though, is the gross amount minus the discount. They'd only have to borrow the net amount, obviously, because they're not paying the full gross. So they're going to borrow the net after the discount, the $5,794,740, times 8%, which is the bank's interest charge, but only for 30 days because they're still paying on day 40. All we're talking about is they're borrowing for 30 days in order to take the cash discount. So 30 divided by 365 gives us 0.08. Again, I'm rounding it. It probably is an odd number. And then we'll multiply that out to get to our interest. So then our interest is $38,102.40. So they could save $118,260 and then pay the bank $38,102.48, or sorry, 40 cents, for a net savings of $80,157.60. Now then we have to figure the tax impact of that. So then the tax rate is 40%. So just as a time saver, I'll multiply it by 60%. You could multiply by 40 and subtract it. But then the overall impact on the net income is going to be $48,094.56. Okay, then the last one, I'm sorry, I didn't type that up. We have where we're going to calculate our cash conversion cycle. Okay, so then what they give us is sales of $250,000, and then they give us cost of sales of $135,000. Whoops, I put too many zeros in there. And then what we want to do with those is we want to figure out daily numbers, though. So we're going to take each one of them and divide it by 365. So that, and then I'll make it a currency so I don't see all those decimals. So that's $684.93 a day in sales, and then $369.86 in cost of goods sold. Then they give us the inventory of 45,000. So if we want to get, whoops, I'll come down here. Our age of inventory is one of our numbers we're trying to get. Our inventory balance is 45,000. And then if we divide that by the 369.86 of cost of goods sold, that gives us our days of inventory. Okay, then if we want our accounts receivable aging, we are going to take the accounts receivable, which they give us, 20,000, and then we're going to divide that by the daily sales, which we calculated up here, the 684.93. And again, divide those. So then that gives us our age of inventory at 29.2 days. And then our payment period, we take our accounts payable, which they give us, the 32,000, and then we divide that by our average cost of goods sold, our daily cost of goods sold. And that gives us 86.5 days. So then our cash conversion computation is going to be the 121.67, I'll round it, plus the 29.2 minus the 86.5. So then it's going to be that plus that minus this. And that would be our cash conversion cycle. So you have to be able to kind of do the math to get to these average ages of inventory, our accounts receivable aging, and our payment period. But again, after working through all those ratios on your project, you should be comfortable with that. Okay, so then that is it for test 3.